Hello, chart watchers, and welcome to this Wednesday, February 7th, Market Watchers Live show with your hosts, Tom Bowley and Erin Swenlin. For those of you joining us for the first time today, welcome to the show. We're glad to have you. And for our regulars, welcome back. Well, the market after yesterday seemed to be trying to put in a bottom, and so far the action today is trying to confirm it. We do see the Dow Jones Industrial Average up today, up about 300 points. The S&P 500 up 23. The NASDAQ on a relative basis lagging a little bit, but up 27 points. And also lagging is the Russell 2000, but it is up 4 points today. The 10-year Treasury yield back above 2.80%. I think that's significant as money begins to exit the bond market once again. Volatility index, after hitting a high up near 50 early yesterday, we have pulled back quite a bit today after retreating significantly yesterday afternoon as well, and we are now back down at 22 on the VIX, well off of yesterday morning's high. The industrial group continuing to perform well today, up $1.10 or a little bit more than actually almost 1.5%. XLY industrials, the discretionary stocks also doing well. Technology though is lagging, and I'm going to talk about seasonality later in the show, but this is the time of the year when technology does tend to lag a bit, so we'll take a look at that later in the show. Defense stocks within the industrial space having a really good day, up close to 3%. Home builders continuing to rebound off of their recent low, and they recently tested a 20-week moving average, which I think is significant. And finally, media agencies also in the discretionary space bouncing back and climbing back above its 20-week moving average after recently breaking a downtrend. So those are some of the top areas of the day. And let me bring in my co-host, Erin. How are you doing this morning, Erin?
I'm doing quite well this morning, and I actually don't have my audio muted for the first time in a few days when you came on to ask me how I'm doing. No, yeah. It's a beautiful day here in Southern California. We've got a high of 85 coming up today.
Well, that's a little warmer than we have it here on the East Coast, although things are a little bit better. We got some rain here. I'm just a little south of Charlotte, North Carolina. And so we got a little bit of rain here on the East Coast, but temperature is not nearly as cold as we saw throughout much of January and into early February. So things are starting to look up a little bit. Maybe we'll get closer to springtime. And, of course, me being the golfer, I can't wait for the Masters coming up in April. It should be a good one as well. But we do have a special guest on today, Gordon Scott from Investopedia. How are you doing this morning, Gordon?
I'm doing well. Thanks, Tom.
Yeah, it's great to have you on the show. We look forward to you kind of bringing everybody up to date as far as, your background. And I know you're an avid trader and got some crazy markets. So I think timing of having you on here is pretty good. But we're going to get to your presentation probably in about another 15 minutes or so. So hopefully you can stick in with us for that. And Erin, I'm going to let you go ahead and take over, and let's get into the announcements and the agenda for today.
Absolutely. So our weekly schedule tomorrow, we have Arthur Hill coming in. He'll be giving us a segment, I think on the VIX. We'll be talking about that. And Tom has his workshop on Friday. He'll be doing stock charts, tips and tricks, some of the things he uses. So that'll be great. Today, though, we have Gordon Scott. That is really, we're going to have him for a lot of the show today. And yes, I think 20 stocks to rule the world is a very interesting topic. So stick around for that. He will be on shortly. 10 and 10 to 1. The very first stock we're going to look at is Bristol Myers Squibb. So if you want to go take some notes and come back and see what Tom thinks about it, you can do that. And finally, we'll finish off with a seasonality report. And with that, it's time to get going here.
Let's jump on in and take a look at some of the technical stuff going on today. There was no no economic news out this morning, nothing of significance. So I'm going to kind of skip over the 10-year Treasury yield. I did mention it was up a little bit this morning. Routinely, I like to start off with that and what's going on with the economic reports, but really there's not a whole lot going on there. And believe me, what this market right now is really about is volatility. That's what we've been seeing over the past several days. So I thought I'd start with a chart of the volatility index. This is a monthly chart that goes back to the turn of the century. So from 2000 through the early stages here of 2018. And what I really want to just point out is how the volatility coming across here, you can see that the tops in the 40 to 50 area have coincided with some very significant bottoms in the S&P 500. And if you just think about it, it's really when you get the volatility index up to the 40s and 50s, and I know, yes, we did one time go up to 90. To me, that is an isolated occurrence. We had a financial system meltdown, unlike any other bear market, really, that most of us remember. And so I kind of, chalk that one up as maybe a once in our lifetime kind of event. But you can see that there have been many other spikes in volatility where we go up into that 40 to 50 range. But if you notice, most of these 40 to 50 VIX readings coincide with some pretty significant bottoms. So with the VIX reading yesterday up near 50, you can see we just pulled back a little bit, but the market had been going up really nonstop for about 2 years with almost no pullbacks. I forget the number of days, but I know we set a record for the number of days in a row without the S&P 500 pulling back at least 3%. And so it was time, and we've certainly done that with the S&P dropping almost 10%. But a lot of fear suddenly crept into the market with that. And if you go back and you look in 2015, when we got up just above 50, you can see it coincided with a major bottom, although we did come back down and print a double bottom. So we did test that area. If you go into 2011 with the big drop or the big spike in the VIX here, you can see that it essentially corresponded with a major bottom. And if you go even into 2010, big spike here up into the 40s on the VIX. But we were just coming out of the bear market 2007 to 2009. So I think these readings maybe in 2010 or 2011, all of that selling and that nasty bear market, the financial meltdown, all of that was still fresh in just about every trader's mind. And so I don't think it took a whole lot of selling for everyone back then to really get fearful again that we were going back down. But we can go back even further, go back into the early 2000s during the bear market, and you can see these spikes up into the 40s and 50s. Now, these spikes didn't necessarily set long-term bottoms, but many of them did set short-term bottoms. So once we're in a bear market, I think that the VIX readings and how we use them are much differently than during a bull market. I'm going to show you a couple more charts on this. I'm going to go back. You can see here the 2015 spike. Here's the 2011 spike. One thing that you don't see here, but there was a similar spike back in 1998, the summer of 1998. And that was in the midst of a pretty significant bull run in the late 90s. So I think that is maybe a little bit more similar to what we're experiencing right now than these others. But I just want to kind of take a walk back down memory lane, and let's take a look at the VIX and what happened during these years. So I'm going to first start with 2015, then we're going to look at 2011, and then I'm going to pull up 1998. So let's take a look. First, here is the S&P 500 in 2015 coming across. Let me see if I can maybe make this a little bit bigger for you. But this is 2015, and you can see that prior to the big drop in the S&P and prior to the huge spike in the VIX, the S&P 500 really wasn't doing anything. We were going sideways, very different than what we've experienced the last 6 months prior to this huge VIX spike. So I don't think that the mindset of the trader, I don't think anything is really similar to what we experienced back in 2015. The other thing I would say is that we saw the weakness in August and September, which is typically when we see the market decline. So, a lot of arguments could be made here, but the one I just want to stress is I don't think that the VIX drop now in this, after this straight up move in the S&P 500, I don't think the VIX accelerating is similar to what we saw back in 2015, just because, again, we weren't in the midst of this runaway bull market, a raging bull market at the time. We were mostly consolidating through the first half of 2015 before we saw this selling escalate. But I would say this, the low that we made in August with the VIX up in the well into the 40s, we never went back down below it. We did kind of go back and put a double bottom in, a test of it, but we never took out that low. So let's move back to 2011. And again, let me make this a little bit bigger for you. So there's 2011 coming across. Very similar to 2015 to me. Sideways action throughout much of the year, and check out when the selling occurred. It was again over the summertime. So we lost key support. The VIX skyrocketed. This one, we did actually get some multiple tests, and we went down 1 week, or maybe a couple of days here. We did manage to go below that earlier low before bouncing back. But essentially, this huge move up in the VIX and the panic sell-off that took place marked a very significant bottom in 2011. Now let's take a look at the last one I have for you, which is back in 1998. And in 1998, if you recall, I was trading back then. I'm sure many of you all were as well. The late 1990s was a huge rally in our major indices here in the U.S. Huge rally, and you can see right before we started the increase in the volatility in late July and August, you can see that we had just set a high in July of 1998. We were very overbought, not nearly as overbought as we were here in 2018, because we did have sideways consolidation for a few months before we made the last breakout. So I don't think it's the exact same situation, but it was during a pretty significant bull market where all of a sudden things went haywire. One big difference, though, notice again, this is a summertime swoon. I've talked a lot about seasonality and how it's really not a go away in May. It's more of a, go fly in July or something. I mean, you want to leave the market historically, in my opinion, around the middle of July and come back toward the end of September or into October. And you can see this was just another example. All three of these were examples of summertime swoons where the volatility shot up, we went down. Notice again, here we got a double bottom in play, double top on the VIX before that rally continued in 1998. And then, of course, we had that huge year in 1999. So I think that the current situation likens this period in 1998 more so than 2011 or 2015, but that's just my opinion. Now, if we take a look currently at what's going on, and I'm just going to, let's take a look from 2017, beginning of the year, and we'll just go up through today. And update. And so here's the chart now. So I'm going to scroll over here because this is really the only part of the chart that matters. But here is that huge sell-off. And here was that major spike. Now, remember, the VIX is only showing the closes, so it's not showing that intraday move up. I could change. Actually, let me go down here and change this to a candle. All right, so this now shows you that intraday move yesterday up to 50. But based on that long-term chart, and when we looked at the VIX, when it would get up into the 40s and 50s, that coincided with major bottoms in the market. Now, I talked a lot yesterday about the fact that we are seeing some great action, and we have been seeing great action over the last year in the aggressive sectors relative to the S&P 500. So we've seen technology performing well. We've seen industrials performing well, consumer discretionary is performing well, and financials. All four have been outperforming the S&P 500 over the last year. And I think that's significant because what it's telling us is that traders are still willing to take on risk. And that is one common ingredient of bull markets. You've got to have folks willing to take on risk. Many times these bull markets will come to an end where we start to see the sector rotation turn to a point where money is then rotating so much toward defensive sectors that they begin to outperform the S&P 500 as the S&P tries to break out. And that, to me, is just repositioning of smart money before a bigger decline. I don't see any of that going on in the market. So I remain very bullish, and you have to understand that I'm going to continue to take a bullish view. I mean, you might say, hey, Tom's got his rose-colored glasses on, but I don't see any signs other than the VIX spiking. I really don't see any signs of a bear market. I mean, we do have treasury yields going up. A lot of folks are saying, well, my gosh, interest rates are going up. Well, they're going up, but they're going up for the right reasons. Our economy is strengthening. They're going up from historical lows. And as a result, I think that, we've got a market where money coming out of the bond market is going to be available to fuel an additional leg of this bull market to the upside. So I think we're in the stage where we have finally gotten that pullback that we need, the correction that we need. And I actually, in my blog this morning, posted, I think we're going to go into some sort of a continuation pattern now. It might be a triangle. We may see a symmetrical triangle, an ascending triangle, some kind of a triangle formation maybe over the next month or two. But I believe ultimately that we are going to go higher. And some of this research and history is what I'm pointing to. Now, with that, I know we have a number of upgrades and downgrades, so I'm going to turn it over to Erin, and why don't you take a look at a few of those for our audience?
Absolutely. We actually had quite a few upgrades. I'm only going to go over 3 of about, well, looks like 9, 8. So let me go over and share my screen. All right. Here we go. Let's go over here. All right. So we actually did, like I said, we had 8 upgrades, and I can give you those symbols, but I'm only going to go through 3 of them. So let me go through the 3 I'm going to do, and then I'll tell you what the other symbols were if you wanted to go back and look at them. So the first one is, let's get this out of edit view. The first one is Newtonex, NTNX. And I went ahead and marked this one up. I think it's hit some really important support and it bounced off of it, including that 200-day EMA. We have gap resistance now, or support here that held up. And, you know, that gap never closed as far as when you're looking at it coming down over here. I am a little concerned about that overhead resistance, but look at the 20-day EMA has turned up before crossing below the 50-day EMA, and that prevented a neutral signal as far as the decision point trend models. So I like to see that PMO turning up. So I think this one, there's some potential here. If we can get above that area of overhead resistance, I would definitely like to see price close above at least the 50-day EMA at this point. So that was one of the upgrades. Another one I have is, let's see. That was, make sure I don't pick the wrong ones here. Okay, CoreLogic, this was one. CLGX. This wasn't one of them. I apologize. My bad. All right, I need to mark these so that it's a little bit easier. Okay, Limited Brands. This was one of the downgrade or the upgrades as well. I like the setup on this chart. I think it's pretty positive. We've got this test of support here. I think you can make a pretty good case for when you look at these previous bottoms. But like I said, right now, what worries me is the 200-day EMA right now is posing some overhead resistance. But I like the bounce. We're seeing a nice move up. Could end up getting ourselves up here to this overhead resistance. But with this gap here, I think it's really important that we get up above that resistance, and then I'd look for that gap to close. So I think that was a pretty nice upgrade. And let's see, yes, ALLT. This is for you low-priced, high-volatility traders. I don't do this. These aren't the kind of trades I do. But as an upgrade goes, this one really looked good as far as our decision point timing models go and our PMO. Got a PMO buy signal right now. You can see a positive divergence on the OBV, which is something I like. We've got that gap up above both the 50 and the 200-day EMAs. 5 is getting ready to cross the 20-day EMA for a short-term trend model buy. The important spot, I think, is to get above the resistance of these previous tops. So that's what I would be looking for. But, you know, you can see I didn't draw in that declining tops trend line, but we got that breakout, a gap above it. So I think this one's looking pretty strong. The areas of overhead resistance I'd be watching, of course, is to hopefully get above that 540 level. But when you're looking at a low price stock like that, even just that move to the 540 level could be lucrative. So I thought I'd throw that one out there for you as far as the upgrades went. So those were 3 of the upgrades. We also saw CLF had an upgrade today. We had Dish had an upgrade today. CME also had an upgrade today that I did not cover. And ANTE would be another. an A core. And I think that one I did look at briefly. We're almost to the end. I have 3 downgrades for you as well. So we can see hit overhead resistance pulled back. It looks like we're coming up to test a declining tops trend line. But as far as my timing models go, I don't like it. The PMO had a sell signal. It's heading back down, seeing some deceleration. But even with this upgrade, I mean, I'm not a real fan. I certainly wouldn't jump in, but there are a couple of reasons why you could. You've got a long way up before you hit that area of overhead resistance. But I would draw that declining tops trend line in there and look for a breakout before I would jump into something like this. All right, so the next one I'm going to show you, we have 3 downgrades today. The first one is PSTG. I'm going to put that one in to look at. And I like this. I know these are downgrades, but I think there are times when they're still good candidates. You know, I've got a really nice positive configuration of the trend model EMAs. The 5 is above the 20. You want to see the fastest on top, and that's what we're seeing. Got a bounce. It did dip below this area of support, but it's finding support now in that 20-day EMA, and I think this is going to hold. You've got upside potential to about 2150. Not bad. Not a bad setup. CBOE was another, and I make sure. If I already have an annotated chart, that's what I want to use. And I'll have one more after this. I thought this one was rather interesting because you got the bounce right off of that 200-day EMA. I mean, you couldn't pick better support there. And it is starting to head back up. Overhead resistance, I'd be looking about 120. This is an ugly PMO. The scooter is terrible right now. That stock chart's technical ranking. Obviously, volume is not looking good, so we're seeing that decline on the OBV. But, you know, I could see a bounce coming up here to at least test that 120 area. And if we got above that, look for a test of that gap resistance right there at about 125.50. Final one I have is ICPT, Intercept Pharmaceuticals. And as far as getting in something as a downgrade, I don't like this. If we can get down here to that support level from the January lows and get a little bit of a bounce off of that, that would be good. But right now, momentum is starting to fade, obviously, with this declining trend. And you can see the PMO is now topped and is getting ready for a sell signal only just above the 0 line. This is just, you know, when I look for candidates, I like to see a better setup of my EMAs. Right now, you've got the exact opposite configuration you want with the slowest EMA on the top and moving on down to the fastest. And I don't like to see that on something I get into. But this one might be worth a watch to see what happens if it gets down to that $50 level. And that's it. That's all I had for the upgrades and downgrades. So let's go ahead and bring in Gordon. I know we have lots of interesting topics to talk about there. So Gordon Scott, I became familiar with you through the it was the MTA, Market Technicians Association, now renamed the Chartered Market Technicians Association. And I know you did a lot with you do a lot with investment education, and I think that's quite valuable. And I know our viewers are always interested in educational topics. And, you know, you've done a lot for the TA community, I have to say, by getting in there and revamping the educational materials. So anyway, just want to welcome you to the program. And I guess you could go a little bit more in depth about your background, and let's do this.
Okay, thanks, Erin. I appreciate the opportunity to be here and talk to Market Watchers folks. And I wanted to really bring out a few insights of what's going on today from my perspective. So I'll get a chance to do that in a bit, so that everybody who may not have ever heard my name before, that's probably most people, knows why I have the insights I do. My background is that I have spent many years coaching individuals one-on-one to learn trading. And along the way, I've also, out of that experience of recognizing what it takes to teach people to actively invest or to trade, I've recognized that the materials that you need need to have the right orientation, need to have a solid backing in risk management and understanding of the appropriate point in your trading or investing system that forecasting plays. Now, too many people think forecasting is everything, and forecasting is actually a very small portion of it. But throughout these years that I've been trying to bring these insights, I've worked with a number of organizations, Invest Tools and TD Ameritrade and Thinkorswim, Beacon Learning Group, Van Tharp Institute, Learning Markets, and most recently I was the managing director for the Chartered Market Technician Program. And the great thing about that is that I got to interview hundreds of people about how technical analysis is used in industry. Now, if you have a job where you get paid to do technical analysis for one reason or another, what are the people paying you for? What is it that where do you actually provide your value? And so we did a year-long study about that in order to make sure that the curriculum of the CMT program was industry relevant, and that's where it is today, is based on those insights. And that was a lot of fun because I got to learn all sorts of things about trading or investing along the way that I added to my own basket of tricks in my own personal trading. I'm part-time trader. I love to trade, and I always have felt it important over the past almost 20 years to make sure I have a job that allows me to trade because that's just what I want to do, and I really enjoy it. And I'm also happy that I'm getting better at it over the years, because otherwise it wouldn't be worth continuing on. Most recently here, though, I've moved to Investopedia. Investopedia Academy has actually started up an initiative called, Investopedia started up an initiative called Investopedia Academy, and they asked me to be their head of education. So we're putting together a number of courses, online courses that we think are high quality and very worthwhile for people. And occasionally on Investopedia, you have these wonderful, insightful articles that come across over 200,000 individual things. But one of the particular pieces of information that is on Investopedia is unique. It is the Investopedia Anxiety Index. I'll get to what that's going to be a little bit later. But before I do, I wanted to take an opportunity to talk about a couple of things on StockCharts.com that I use regularly as part of my trading, and in fact refined the use of these things as a result of my association in the CMT. Certain people in the CMT association kind of gave me ideas that led to this, and this has just been a very useful thing to add to my trading activities and investing activities as well. So I want to share that with you today. And this is a little method that I call 20 stocks that rule the world. And the basis of it is this notion that there are times where the S&P 500 makes certain patterns, and you can expect to get gains. You can expect that there will be a period of 3 or 4 months where you'll have an accelerated returns, better returns during this time of the year or for the next 3 months because of certain things that have set up and created conditions, whatever it is, that you want to be participating a little more heavily in the markets during those times. And so I looked at ways to try to figure out how to do that, and the first place I went was to hear the performance chart, the perf charts on StockCharts.com. So just if you aren't unfamiliar with this, I want to show you how I get there and how anybody can get there. You just simply from the main page, look for the sharp chart, and then you're coming to look for a performance chart. And then as you do, it'll bring you down to this page where you can actually select one of the predefined groups. and you can select the S&P sector ETF. So I'm not going to select that because I've got just a slightly modified version of this. I included the real estate sector into this. So here we have 10 sectors, 10 major sectors of the S&P 500, and this is a one-year comparison chart. And what you're looking for is what's on top, what's doing the best. And I like to compare what's on top with also what's on the bottom. And here's the little rule that I came up with that has served me quite well over the years. And that is, if you find utilities or healthcare and consumer staples, you're looking at those three sectors, and those are kind of the defensive sectors. So healthcare is in there, the teal colored one, right? If two of the three of them are on top, or if two of the three of them are on bottom, either one of those is significant occurrence. If they're on the top, that means the market participants are nervous. If they're on the bottom, that means that the market participants are more interested in taking on risk. So when people get afraid of risk, they go to those three sectors in some combination. So that's the first thing that I'm looking at. And right now, as you see, even though we've had this huge dip, at least from a 1 year perspective, those sectors are not making a big jump up. In fact, they're even as they're coming back up from the dip, even as stocks are coming back up, those ones are not performing well. Utilities, the bottom one, notice it's going down. So if people were really afraid of taking risk right now, you'd see this utilities line spiking up very strong, and it's just not doing it. So absolutely confirming what Tom was talking about earlier, that the chances for kind of putting in a bottom here are pretty good, at least from the attitude of market participants. So, but I decided that, how do I extract this into individual stock plays? Is there a way to do that? And it occurred to me that if I consider how correlated these these ETFs, the XLY, XLI, all these, right? How correlated are these sector ETFs to the market in general? The answer is they're very correlated. In fact, here's just some simple numbers. If I take SPY and I look at XLB, XLF, XLK, XLY, just as a simple matrix, I mean, you look at these high 90 correlations, right? It's not as though they're the same, but they're so close that we understand that one is driving the other. Well, these work with a little bit more beta than S&P 500, so these drive the bigger index. And I reasoned, well, if that's true, then what about the stocks that are kind of driving the sectors? Well, those are what I came to call the 20 stocks that rule the world. And to find what they are, you simply Google your XLB or XL, or your favorite ETF, sector ETF, and Google its holdings. Look at what the top two stocks are. In this case, XLB, Basic Materials, Dow, DuPont, and Monsanto, right? Well, the reasoning went like this. If I think XLB or other sectors are going to be driving the S&P 500, wouldn't it therefore be true that the most heavily weighted stocks in the index, I mean, look at this case right here. Dow is 23%. Dow DuPont, 23% of XLB is Dow DuPont. XLB is not making a move the Dow DuPont is not making. I mean, you can see the connection, right? Monsanto is 7%. Put that together, and those two stocks are a third of the index, a third of the ETF, that is. And if this ETF is driving the S&P 500, then whatever these two stocks are doing is going to directly flow through to the S&P, to SPY, S&P 500 index itself. And to bear that out, look at this quick correlation. Here's Dow DuPont, JP Morgan, one of the top two in the XLF. Apple, one of the top two in XLK. Amazon, one of the top two in XLY. And look at those correlation numbers. You got some 80s and 70s, but generally speaking, it's very strong stuff. So it became clear to me that the overall influence that these individual stocks have on the rest of the market, and all markets at large, really, if you think about it, is extremely powerful. And so if I want to outperform the markets, I really want to pay close attention to those 20 stocks. So I came up with this methodology here of putting together a 3-month chart. So notice that's not the 200-day, it's the last 3 month. 3-month chart of those 20 stocks, 10 in each. So here's 3M and GE. That's the top 2 of XLI, and so forth. And if you look this stock, if you just look at what's happening in the past 3 months, and more importantly, since this big downward move, right? Everything dipped because of Monday, and then now we're kind of rebounding. Which one's rebounding the fastest? That's the kind of stuff I want to know about. Here in the real estate sector, you got D.R. Horton. It's not doing too bad, but the strongest one very clearly is this top one. I mean, not only is it the top one, but it's also rebounding the fastest, and that's Netflix. And so we're going to have a look at Netflix's individual chart in a second here, but let me show the other 10 while I'm at it. Here's JP Morgan, Wells Fargo, DuPont, Monsanto. We mentioned these before, right? Same kind of thing. Nice upward move. What's doing the best? Right there, it's Microsoft. Now, you might not be thinking of looking at Microsoft right now because, it's kind of a dowdy stock and nobody necessarily likes its technology. It's not as sexy or as flashy as things you hear from one of the FANG stocks. It doesn't even merit one of the letters of FANG, right? But there it is, right on top, and with a very strong bounce here over the past 2 days. So that's the kind of insight that I'm looking for. Oh, that's a 200-day chart. Sorry, let me look here in the past month, see if that's any different. Okay, so there's Microsoft tying up with JP Morgan. I mean, would you be thinking about, hey, I need to be checking out JP Morgan right now? I know I wasn't, but these two are looking pretty good. And then this one right here, Dow DuPont, a big jump over the past couple of days. So with insights like that, you see, I'm armed to the idea that if I want to put an individual stock into my portfolio for the next 2-3 months, or even if I just want to do a trade for the next 1 to 2 weeks, a swing trade, which ones am I going to likely have wind in my sails with? What'll have just a little bit of buoyancy and will catch correlation benefit? The answer is these. And so that's going to lead you to look at something like this. So here's the Netflix chart. The nice thing about what we see with Netflix is this wonderful gap right here. And the reason I say wonderful is whenever you have a gap where it's significant and strong and it comes back, retests, holds, and then starts going back up again, then you have a better than average opportunity for outperforming the markets over the 20 days that follow. That is a finding that came from a study that won the Dow Award back in 2011. The Dow Award is something that the CMT Association awards to people that publish in the Journal of Technical Analysis annually. And in the year 2011, the paper that was published on gaps by Charlie Kirkpatrick and Julie Dahlquist, they did a very exhaustive study on gaps and came up with certain things that mattered. It's worth Googling to try to find the paper that they did on the Journal of Technical Analysis. And if you scour through that, then you come up with a couple of insights, one of which that I extracted from that was that there's about a 65% chance that you're going to outperform the S&P 500 if you have a gap in an upward trend, particularly if it starts a new trend. So the best signal on this chart is actually back here, right at the beginning of the year, because it starts below the moving average and gaps above the moving average and closes higher. Those are the three categories that kind of define the idea of a new trend. And in fact, that absolutely plays out here. We're going sideways, and now it's strongly up. Meanwhile, this is a bit of an accelerating gap, and it's come up, it's retested, and so you love the look of a thing like this. Plus, we saw all the relative strength that is going into Netflix, and how if everybody's going to put money into the S&P 500 generically, right? People are just investing in stocks. They put their money in a stock growth fund in their 401k, or they hold a Fidelity mutual fund that is an index fund that maps the market in general. Well, that money just kind of gets distributed to the various items in the S&P 500, the various individual stocks in the S&P 500, and then the stocks within them that are doing the best, then they just get that much more momentum added to them. And so that's why you have a stock like Netflix having the opportunity to really benefit from that. So from all that, we distill down to the notion that Netflix is pretty good. Right here, I'm going to pause for any sort of questions or response, but I wanted to add into it another explanation of why we might actually have a good sense of why people want to still be in the mood to continue to take risk. It's something that sort of correlates with that. But before I get there, let me just pause to see if there's anybody that has questions out there that is going along with this.
Hey, Gordon. I just had a personal question. That was just maybe to give everyone a sense. I mean, when you trade, you said that you're an active trader and you've traded for a long time and you like to carve out time. I guess maybe the first question, you talked a little bit about ETFs and you talked about individual stocks. Do you trade both? And do you do so like depending on the riskier environment, like with the volatility being so high today? Would you maybe look more toward ETFs versus individual stocks? I mean, how do you manage your risk? You said earlier in your presentation that risk management is a big part of all of this. So how do you manage your risk when you're trading?
Oh, great questions. Thanks for asking all. So personally, I consider myself a sort of a slow motion swing trader. That is to say, I don't think of myself as a full position trader. I do hold a position as long as 3 or 4 months if that position's that good, but that's a little more the exception to the rule. I'm usually in and out of stocks in a time frame of 2 to 4 weeks, and sometimes though it's just a day or two, right? And it really depends on the conditions I see in the market. I like to think of myself as a trader with a basket full of a variety of strategies, and I pull out the different strategies based on what I see in the market. So right now, you asked the question, would I favor ETFs over individual stocks in this sort of high anxiety market? Yeah, absolutely. I do consolidate into more ETFs and index-based ETFs when things are kind of going crazy, because individual stocks carry so much more risk during those kinds of times. When there's less volatility in the markets, then I look at individual stocks more primarily. I'm a lot less interested in index ETFs in the circumstances where we're in low volatility. But in addition to ETFs and individual S&P 500, highly liquid stocks, I am also interested in small cap and even penny stocks. Very, very sparingly. I'm very careful, very sparingly using those kinds of strategies. But it's interesting because when the market seems to kind of hit doldrums, you got a low volatility market, but it's just doesn't seem to be going anywhere. Then investors get antsy and they want to find quick returns, and they start shopping for value stocks and penny stocks, and you can find an occasional trade there that really makes a big return. I had over the fall a stock that went from $2.50 up into the $4 range. On an absolute basis, that's not much, but on a percentage basis, boy, that does a whole lot for your portfolio, right? So
I would have been out. I would have been out at about 270, 275 probably.
Yeah. So I actually held that stock for I think I'm trying to remember, it was just under or just over a month, but it was about that period of time, and it just had a nice run, and the idea was stay with it until it shows signs of weakening, and so I did, but that was, I hadn't traded a penny stock for more than a year before that, so it was entirely driven by what's going on in the marketplace at the time.
Would you categorize yourself as a momentum trader? I mean, are you looking for stocks that are in clear uptrends and maybe getting the volume to support moves to the upside? I mean, I guess number one, are you a momentum trader? Number two, do you consider the volume?
Number one, I'm not a momentum trader, but boy, I do love to trade momentum stocks. It's one of my strategies, right? Just one of the things that I pull out of the basket. I'm an opportunistic trader. I like to trade short, trade long, trade alternative stuff, trade highly liquid stuff. Love to trade momentum and relative strength stocks. As you saw, looking through the relative strength charts there, looking for the stuff that was strong and staying with it. That tends to be a very time proven strategy. There really is an opportunity to get better than market gains by staying there. So I don't exclusively trade that, but when markets are low volatility and bullish as they have been for the past 3 or 4 years, that's usually an excellent place to have a chance to outperform the markets, which is very hard to do. In the past 3 or 4 years, the markets have been so strong; it's been hard to be stronger than they are.
Mm-hmm. We did have a question more on the mechanics of the gap chart you were looking at for Netflix. Their question is, how do you know when to buy on the gap? Do you buy it when it's formed, or do you wait for a pullback? I mean, obviously, there's no set rules on this, but typically, what are you usually looking for?
The study that was done actually used the rule to buy the open of the day following the gap. So in this example here on the chart, it would be to buy the low of that white candle on Netflix, the second candle after the large gap. That was the rule that the study was testing against. They weren't so much trying to test a trading rule as they were just testing returns after gaps. But the funny thing about these academic studies that anybody does is that it's a trading rule. They create a trading rule, even if they don't say it. A lot of times they just try to cop out of a trading rule by saying, well, what were the returns after 30 days or 6 months? Or so that rule translates into buy now and hold for 6 months. So
right.
the rule was by the opening of the day after the gap, the way they had conducted the study. And that turns out to actually be a worthwhile rule. Just buy the price so long as it hasn't closed the gap. And when you have a big gap, of course, that's not going to happen. In looking at their data, what I found though is that you get about what happens here with Netflix is unusual. You get this jump up and run right away. Usually, actually, what happens is within 5 days you'll retest the gap. Here it took longer than 5, it took 10. But within 5 days, you will retest the gap. That's what their studies seem to indicate. And even though they weren't looking for that the data did show that. And so my rule has been, if you get a gap and you get a day, especially if you get the gap and it closes higher than it opens, which is also by itself a very strong indicator that hey, you want this. Then I'm looking to buy below that closing high price, but above the gap. So in this case, I would be targeting between 250 and 260, and just setting a limit order, expecting sometime in the next 1 or 2 weeks to be able to get filled. And of course, that plays out picture perfect here in Netflix. But back here on this day, you would never have gotten filled. So it's a risk to take a rule like that because you will miss out trades. But when you take a trade, the benefit of doing that is that you have a very clear sense of where your stop loss is. The idea is that it's got to not fill the gap. So if I have the stop loss at the bottom of the gap, or even the middle of the gap, I'm probably going to be okay. If I get stopped out, I probably don't want to be in that trade anyway. It's probably not going to continue on higher. If in fact I get in and I don't get stopped out, I probably am in that 65 percentile of stocks that are going to outperform the market. So rule-wise, that's actually how I like to approach it.
It's been a really enlightening last 30 minutes or so, Gordon. I know, it was great news to get you on the show, and I'm certainly hoping that you'll be able to come back and, kind of follow up and do another presentation with us sometime in the future. It's been a great having you on the show for sure.
Well, thank you very much. I'm sorry we didn't get time to go through the Investopedia Anxiety Index, but I would recommend anybody who's interested do have a look at it, because there's a nice little chart I'll just tease you with to tell you why you'd want to. But other than that, if we're out of time, I appreciate you guys letting me come on.
Yeah, well, we definitely would like to have you come back on and talk a little bit about that index, because I do think that anything that, where you can deal with the sentiment, because every trader, and it as a trader, and I know it as a trader, the hardest thing sometimes is just dealing with the mental side of trading, the emotional side. When you're down on a trade, what do you do? The market doesn't look great. You're down. Do you take that loss? Do you hold on? Do you wait till the close? And your mind plays tricks on you. It's like, well, I violated my support level, but there's another support level, and then there's another support level. So anyhow, I think anytime you get an indicator like the anxiety index, I think that would be something that I think everybody would be interested in. And maybe we use that as our topic for your next visit.
All right. Thank you.
Yeah, it's great to talk to you. I really appreciate it.
Yep. Thanks so much for joining the show. It was great. I know our audience loved it, and we'll be sure to have you back again real soon.
Thank you.
There he goes.
All right.
Scott of Investopedia. It's fun having these guests on, Erin, because everybody's got a little different style, got a little different approach to the market. I was actually happy to see that Gordon had, maybe a little bit shorter term, approach to the market, because of course that's what I do.
Right.
But everybody's got their own style. It was great hearing his.
Yeah, absolutely. And if you are interested in some serious technical analysis learning, go to the CMT Association. And even if you don't want to take those tests, the curriculum itself and what they suggest is great learning. And also Stock Charts bookstore does have the manuals for to get your test levels covered. So they're all in one big book, and you can actually get those on our website at the Stock Charts bookstore. In which I do want to say, before we get started, I did want to, we have our very own Greg Schnell, who recently wrote a book, and it is now for sale. He is currently in the Stock Charts offices today and tomorrow, and he is signing books. So if you would like to get a signed copy of his new book, just go to the Stock Charts store. You can see store.stockcharts.com, and you can get that book today or tomorrow, and you'll get the signed copy from Greg. So just a little plug there. But here's one of the books right here, the CMT Level 1. And like I said, it's a great introduction. I've learned so much by working on that program, and I highly recommend it for anybody who really wants to get into the weeds of technical analysis, which is where we like to go a lot of times.
I didn't know that Greg named his book after me.
Yeah, right? Yeah. So anyway, yeah, highly recommend you check that out. But anyway, let's get on with that 10 and 10. And I know the very first stock, actually, Tom and I talked about it. We're going to split it today. He's going to do 5 and I'm going to do 5. And oh yes, very quickly, go check out our ChartCon 28 registration page. I suspect all of you will do the online version of ChartCon, which I highly recommend. But if you really want to have some fun, join us in Seattle. Come to the ChartCon. You get a front row seat. You get to talk to us all day long, pretty much. Rub elbows with us, have dinner, and you can check out the VIP packages. But those are going to stop for sale. They're not going to be for sale, I think, after February 10th. So we have less than a week here if you want to do the VIP package of just going to the conference, or you can also buy the package that includes the Alaska cruise afterwards, where we'll be going on that as well. And then you get a week of us if you can stand it to hang out with us.
Yeah, no, it's fun. We get together every couple of years for these ChartCon events, and it's such a great time.
Oh, love it. Love it. Have a lot of fun with it. So anyway, with that, Bristol Myers Squibb is our first one, and that's BMY.
All right, let's take a look at BMY. Try to get through these quickly, just show you how I like to use the annotation. And really, I mean, that's, we want to take a look at the stocks, obviously, and see what's going on with stocks. But I really want you to note how quickly you can go through and annotate some of these stocks. So you've got, I could put a couple of different levels here of support. You can see we gapped up on very heavy volume here, but we did come down and just barely break below it on a very short-term basis, just one day. So for me, I would draw support in like this, and you can see we were breaking way below. I love to see these tails where you go down below prior lows, especially on a long-term chart like this, because what it's telling me is that there are a lot of folks getting stopped out. If you're looking for an area to put a stop, you're going to put it below prior lows. And so the fact that the BMY came down below its earlier support around 59.5 to 60 on heavy volume and then was able to close above it, to me, that means that you've got market makers at work and taking a long position, because who else is going to be buying on a breakdown? It could be that market makers needed shares for an institutional client. That's one way to get them, because that you can see the volume. An institutional client's going to need volume.
Hey, we're not seeing your screen. I don't know if you shared it or not.
I did share it. I've got the thing around it. I can stop sharing it, but that's not going to be good.
Mr. Producer, I think we need to get the 10 and 10 slide off. I think that might be the problem.
I don't know. Let me know.
Well, we can just keep talking until...
I think, let me just go ahead and save this one while I'm saving.
You guys are fine. We see your screen.
Oh, okay, good.
All right. Yeah, I had the circular thing around it as though it was being shared, so I don't know. But, BMY, I mean, you can see these are the key levels for me. We're sideways consolidating. I like this stock as long as it continues to hold on a closing basis, 59.50. I think we got a shot to go back up to 65.5.
Excellent. All right, number 2, the one I have for you is going to be STML. STML.
All right, Stemline Therapeutics, nice uptrend in play, sideways consolidation, maybe a little bit of a downtrend line that was just broken short term. And so on this one, I will just highlight that. But you can see recently these highs coming down here. And then, of course, if I grab this line and drag it down, I can get the channel. And so off of an uptrend, you can see heavy volume. We had a nice little channel coming down, lighter volume, and now we're breaking out today. So I look at this as a very bullish looking chart. The PPO starting to turn up again. I'd be long this one as opposed to the short side. I like the long side.
Okay. The next one I have for you is UCTT. Ultra Clean, I believe that is. Ultra Clean Holdings. And they'd like to look at a weekly chart.
Okay, let's pull up the weekly. UCTT. I think right now I would be watching $18 pretty closely. So let me just annotate this and tell you why. But there was a pretty significant pullback right there off of an uptrend. We didn't have much selling taking place. This was really the first area where we saw some concerted selling. And check out the volume on the selling. So that went back to 18. And so holding that level and then breaking to new highs now leaves that, in my opinion, as the most significant support level on the chart. So I actually think the reward to risk here looks pretty good. One point I would make here, though, and I'm not looking for bearish conclusions to charts just yet, but there is a head and shoulder top in. And if you lose 18, you got left shoulder, neckline, head, neckline, right shoulder coming back down. If you lose 18 on heavy volume, I would be out of the stock. So I'm going to keep a really tight stop here.
All right. Let's see. The next one is XOP, the Oil and Gas Exploration and Production ETF.
All right, XOP energy is really struggling here. I don't like what's going on, and I think on the XOP we're at a pretty critical area. Let me go ahead and annotate this one on a weekly basis as well, because I think if you look back over the past 5 or 6 months, a critical area on this XOP has been at about 34. You can see off of the bottom, we rallied back up, pulled back to the rising 20-week moving average. We held it, broke out to a new high, pulled back to 34, went up to another high, and here we are below that 20-week moving average and now testing what I think is pretty significant price support. So this is another one, the XOP, where I think this pullback from 40 down to 34 has created a really nice reward to risk entry on the long side. But a break below 40, if we close this week below 40, I'd be really careful, especially if that volume continues to strengthen.
Okay. Let's see. The next one is ESIO. That's number 5, I believe.
All right. Let me go back to the daily here.
Yeah.
ESIO, I've actually watched this one. I'm a little disappointed in the way it's been acting. I think we're going to go back and hit gap support from back in early November. And that gap support comes in right here. So we got a little bit more room until we're going to have a very significant test down just above 16, maybe 16 and a quarter or so. That was one of the heaviest volume days of the year, was the gap up from that 16 and a quarter area up to 21. We got all the way up to 28, went sideways for a while. I'm going to put in another support level here. After gapping up, we fell back to about 19 and change. And then you'd notice here the next couple lows came down right about to this level. But we have now broken below, and volume hasn't been exactly light. So I think we're in a trading range now between 16 and a quarter and about 19 and a quarter. And so I would do nothing with it right here in the middle of the range. Even with the market trying to rebound yesterday and earlier today, you can see the stock putting in new lows. So I think ESIO, I'd hold off until at least we get down to test this gap support.
All right. That's the first 5. So if you want, I'm going to take the screen and we can do the next 5.
All right. Sounds good. And
right. I'm not having any trouble today sharing my screen. It's so nice.
All right. Are you ready?
Yep.
All right. We'll start off with our Canadian friends asking about MRE.to.
All righty. Here we go. And again, as Tom said, we're really demonstrating how quickly you can annotate and save charts. So let's look at the important support levels. I'm going to get onto the annotate. That's the very first thing I always do, is I'm looking for horizontal support and resistance. And I do like to draw a fat line that's somewhat see-through, because I do see support a lot of times it overlaps. For example, this isn't quite reaching down here, but it hits that top. So that's why I like to use these fat lines. I like the fact, honestly, that we came down and we didn't even have to go all the way down to test that support level. This worries me, and I'm going to put a little circle around it. This would worry me, though, seeing that 20, 50-day negative crossover. But at the same time, I think that is interesting because we're seeing a deceleration in oversold territory of the PMO. So I would probably have this on my watch list just to see what's going to happen with this PMO. But I think we're in a pretty good position here, and I'm going to auto support resistance for upside potential. I think that would be a conservative upside potential right there at the 50-day EMA. But if we really get that breakout and things start to look good, there's other upside potential areas. So that is the first one. I'm going to go here. And that's number 6. All right, next one.
All right, next stock is PETS, P-E-T-S.
All righty. Annotate. Support and resistance. Let's go there first. So I wonder if this coordinates with any support and resistance in the back here. So let's go ahead and pick this. And that is honestly a lot of times where I go first, just what's going on that right-hand side of the chart. I see possible support going here. Fill in the line. Let's see where we might come back to. And look at that gap right there. We're sitting on that that area that you could consider gap support here. Obviously, the gap was already closed, but I think it's very interesting that this bottom seems to be occurring right about there. And you can see the close that happened, even though we spiked above that at the time overhead resistance, it came back down to close pretty much on it. So, you know, I think this looks good as far as support, and we still haven't made that move up. I would watch the PMO again and look for more deceleration. And I would like to see some better information going on the OBV. Right now, it's giving us a bearish confirmation because those tops on the OBV are going down with the tops on price. There we go. And this was 7.
Right. Mm-hmm. Next up is COUP. COUP.
Cool. All right. Interesting. I like the PMO, just looking at that right off the bat. Auto support resistance. And again, I'm looking at these bottoms, so I'm put that in, and lo and behold, it does seem to coordinate with the previous overhead resistance here. Very interesting. So I think the fact that we've hit that area of support, previous overhead resistance, you know, we popped off of it, but we came back, pulled back, and now we're coming up. Could be forming some sort of a flag here. I don't have the candlesticks up because I'm not really that short a term trader, but I'm wondering if that isn't going to come together as a doji. So that could be interesting.
It's also interesting that it's a technology stock, which is not doing particularly well today. And it's in the software space, which is not doing particularly well today. And of course, the market's been weak, and yet you got this stock breaking out to a new high.
Exactly. So I think that that's positive, especially when you're considering relative strength-wise. There is no scooter on this one. Well, it shows 92.3. I'm not sure why it's not showing up on my chart there, but I think that's good.
Great. And let's see, number 9 is MX.
MX.
This is a semiconductor, I believe. Yes, it is.
Wow, they got hit pretty hard, didn't they? All right, that seems to be pretty obvious support right now, and it's getting ready to come down and test it. The one thing that bothers me is we did get that breakdown below that 200-day EMA. You know, we've seen it before, so we really need to bounce off of this area of support, I would say. I think it's very important, and right now we're down there testing it. I'd like to watch that. Of course, as far as my trading style goes, this wouldn't be on my radar just because of the fact that we are looking at a PMO sell signal, and it is moving down from previously overbought territory. So I'm not liking that. We could very well see it fall below that area, but it looks like pretty strong support. So I might have this on the radar. All right.
And the last one, Lumber Liquidators, which is ticker symbol LL.
LL. There we go. Annotate. All right. A lot of people ask me how I get my line, you know, so that you can see through it. If you go in when you're doing other trend lines, etc., and create something that is more less opaque, and then it'll save it down here. And so as long as you have something chosen that isn't opaque, then you're going to be able to get this as your line. So that's kind of how you do that. All right. Had a trading range going on here. And again, where did that bottom go? And wow. Isn't it amazing how the support and resistance lines do tend to work out this way? A lot of this, you know, you can read books about it, but a lot of it's psychological. You know, people remember when they bought a stock or when they sold a stock. So you end up with pretty solid support and resistance a lot of times on the charts. So the PMO is starting to decelerate. So I think that's interesting. And like I said, we bounced off of this area of support. I would be a little worried because this area was the top of that trading range there back in the summer. And, you know, I would want to see that area probably broken above. But, you know, and of course, like I said, this wouldn't be quite on my radar yet. I'd be watching that PMO very closely. And that was the final one. And we did that pretty well considering.
Yeah.
All right.
Yes, we did. And so we do have a
here are the symbols that we did cover today, and half of them are already in the Market Watchers live blog, which I just annotated, and I'll have Tom's 5 ready to go after the show. So we'll put those up there, and you'll see them in the Market Watchers live chart list, and you can get to that simply by going to the Market Watchers live blog page, and the link will be right on top. And there we go. And now I think we're going to do, let's get into a market update. All righty. And I want to go over to Chrome. Let's go to the front page. We're going to look at the candle glance with all of the major markets on it. I usually change this to the TSX for our Canadian friends. And there you go. We started off of that bottom from yesterday and we continued higher, but it looks like we finally found the limit, the overhead resistance limit for the Dow right around 25,250. And we are coming back down to test yesterday's close. So we'll have to see if we can remain in positive territory, but you can see the NASDAQ has already dropped down into negative territory, down currently 33.70. Russell 2000 is in the positive, barely, up $1.37 currently. TSX has been consolidating, started this consolidation at the end of yesterday's trading day and just seems to be continuing along, but it is staying in positive territory at this point, and I think that's something to be happy about. You can see Treasury yields are continuing higher, currently reading 28.23, and we've got UUP on a nice, steady rising trend, and good to see we had that gap up. So the dollar does seem to be making a resurgence here. Might have found that bottom finally. I think a lot of the analysts here at Stock Charts, we've been talking about a bottom in the dollar, and maybe that's what we're starting to finally see here. Commodities are lower, a lot of that due to USO, the oil funds we're seeing really having a very bad day. Started higher, but then dropped very quickly into negative territory and is continuing to make new intraday lows. Gold, on the other hand, with the dollar strengthening, we saw gold pull back somewhat. It is lower at this point in time. I actually was looking at this chart earlier and thought it was rather positive that we could see gold was still consolidating along yesterday's close while the dollar was rising strongly. But now it looks like GLD has started to capitulate, and we're now in negative territory, currently reading 124.78. The VIX, we're still looking at pretty high readings. We're at about 25.5 for the VIX right now. But as you can see, we've had some very serious spikes. We had those yesterday and Monday especially. But now we're seeing them calming down just slightly right now. The declines are leading advances. And let's look very quickly at our scooters. Top scooters, who's in the top 10? Netflix, we were just looking at that with Gordon. And currently, Eco Patrol are the top two urban outfitters, the top 3 of our large cap scooters right now. Very strong relatively to the other stocks. Top up, who's making the biggest moves today? It looks like Hasbro is having the best day so far. And BLL, both of those up over 30 scooter ranking points. So we're seeing readings much higher. Nice gap up here on Ball Corporation. And that's all I have for our final market update. And with that, let's go ahead and get started on our seasonality report. Unless you had something you wanted to point out specifically, Tom, from the market update.
Yeah, the only thing I would add, and we go right into seasonality here in 1 second, I would just add that, it was interesting that when the dollar was falling so significantly, that gold and the miners were not really able to outperform the S&P 500, but yet now we're seeing the dollar rise, and gold, and especially the GDX. I mean, over the last, I don't know, maybe 8-10 sessions, the GDX has dropped probably about 10% or so, and is threatening a pretty significant support level from back in middle of December. So very interesting development. I know you talked a little bit yesterday or a couple of days ago when we were talking about the cause and effect. You looked at dollar and gold, and it worried me when the falling dollar really didn't do much for the price of gold relative to the S&P 500. I mean, a declining dollar should really result in gold outperforming the S&P 500, and it didn't, and it hasn't. And as a result, I think now with the dollar moving up, we're seeing gold really break down, and that's not a great sign.
Right, exactly. Remember when the dollar was really starting to make a move up in this period of time, gold was really just consolidating, and that gave us some pause as far as our decision point timing models, especially when we got that new PMO sell signal on Monday.
Yeah, I mean, gold had a nice run. I mean, you can see it off the low in December up to the high to 1,300. I'm not saying it didn't have a nice run. It did, but it really didn't outperform the S&P 500. If you recall, the S&P 500 was kind of going along for that major ride too, especially in January. So it's just kind of it was interesting to me that with the dollar falling precipitously, that wasn't enough to give gold a boost beyond the performance of the S&P 500. Now with the dollar starting to rally, we see gold really starting to lose all of its prior momentum. So
yeah, I'm looking for a drop to 1,300.
Yep. All right. Well, let's go ahead and take a look at seasonality. It's one of my favorite things to talk about, just because I'm a history buff and I love to see what works and when it works. I don't use seasonality as my primary indicator. I want to make it clear that I like to look, and I think when Bill was on here the other day, Bill Shelby, he mentioned that Grayson looks at seasonality kind of like a tailwind. If seasonality looks strong and you like the chart, it just provides one more tailwind for the stock or the index, and I would definitely agree with that. So let's go first. I'm going to go ahead and bring my screen up, and I am at the home page, member dashboard. And let's start by, I want to show you an article. First, let's go to the blogs. And if you go into a blog, mine or anyone else's, there is this little button here, Blog Archives. So the first thing I'm going to start with, I'm going to go back to about a year ago. It was in January of 2017, so just a little over a year ago. And it was back on January 7th. I wrote a blog article, Summary of Sector Relative Strength by Calendar Month, and I'm going to revisit that first. And I want you to take a look. Now, what this is, it breaks down the aggressive sectors, technology, consumer discretionary, industrials, financials, what I refer to as neutral sectors, energy, materials, and then defensive sectors, staples, healthcare, and utilities. And when you look across here at February, March, and April, and what this is, by the way, this is how each one of these ETFs, each one of these sectors perform on a relative basis to the S&P 500. So this does not say, and I'm going to maybe try to make this a little bigger for you. I think that'll help. Maybe just a tad smaller. There we go. Okay, so if you're looking at technology, for instance, in January, I show 1.2%. This does not mean that technology averages going up 1.2%. What this means is it averages beating the S&P 500 by an average of 1.2% in the month of January. So anywhere I've got the really dark green highlighted or green shaded areas, it's telling you that that particular sector historically outperforms the S&P 500 by at least 1%. Now, when you're looking at February, March, and April, look at consumer discretionary. It's the only month during the year that you have that dark green shaded area for consumer discretionary. February is the best month for consumer discretionary relative to the S&P 500. And you can look at some of these other areas, but February, March, and April tend to be pretty strong months for aggressive sectors, except technology. This is kind of a time of the year when technology takes a break seasonally. Doesn't mean it's going to take a break this time. We could see technology lead. It doesn't lag every year. It's not a guarantee. But based on history, there is a tendency for technology throughout February, March, and April not to perform very well relative to the S&P 500. And when you look at what's going on today, it's part of what's going on with the rally that we saw earlier, and I'm going to pull it up quickly. But under the sector summary, you can see technology down near the bottom. So technology not having a very good day. And consumer stocks kind of in the middle of the road. Consumer discretionary, you can see is flat today. Staples leading a little bit, but industrials, the leader on the day. But that industrials and financials are both part of those aggressive groups that do tend to perform pretty well during February through April. So let's first just take a look at the seasonality tool. So if you get the drop-down menu here, you can click on seasonality, and I'm going to pull up the XLY. And let's go take a look. Now, the default is for the last 5 years. So I want to get more of a history than the last 5 years. So let's go back the last 20. And you can see the stock market in general tends to do very well October to November, or October to December over the last couple of decades. But you can also see February is maybe a little bit positive for the XLY. March and April are very strong months, though, for the XLY. And in addition to just checking out the average monthly gain by each sector, you can also check to see how a sector compares to something else. In this case, I'm going to compare it to the S&P 500. Click go, and it's going to give me my 5-year default again. And I stretch it out. And now you're going to see, look at February. February, when I looked at the XLY, was 0.3%. So it didn't really look like it was that big of a deal. But the S&P 500 actually averages losing 0.5% during the month of February over the last 2 decades. So the consumer discretionary area actually outperforms the S&P 500 by 0.8% during the month of February, and the XLY has outperformed the S&P 500 in 75% of the months going back the last 2 decades. So 15 of the last 20 years, the XLY has outperformed the S&P 500 during the month of February. And this gets back a little bit into what Gordon Scott was talking about earlier in terms of relative performance and looking at which sectors are performing well during versus the benchmark S&P 500. So I just wanted to point out how you can do that. Now, within the consumer discretionary space, there are a couple of industry groups that tend to perform really well this time of the year. So I want to bring up a couple of those. The first one is the DJUSTY. This is the toys index, and that's 5 years. But if we go back the last 19, look at February and March. This index goes up 74% of the time in February, 83% of the time in March over the last 19 years. And the 2 months back to back, 3.2% average gains in February and 3.7% average gains in March. That's almost 7% on average that the toy index goes up over the last 19 years just during these 60 days, February and March. So I think that's interesting. Now, I'm also going to show you within this space a stock that's kind of interesting, and this is Hasbro. Talked about this one in my blog this morning, and I'm going to show you the chart on Hasbro in a minute, but it's absolutely going crazy today. But you can see the average gain on Hasbro in February, 3.8%, March, 5.7%, and April, 4.1%. So we're really hitting a sweet spot here for Hasbro. And again, this is the tailwind that we're talking about. Now let's take a look at the chart. Look at the day that Hasbro is having today after going sideways here for many months. This is a major breakout. They reported their earnings, and I think they may have missed on either, I think maybe on revenues, I'm not sure. But clearly the market, whatever they had to say, maybe they raised guidance. But clearly the market likes it. We are breaking out above a key resistance area. And again, keep in mind, we've got these seasonal tailwinds in the toy area and especially on Hasbro as we make this breakout. So that's what I use seasonality for. It's not necessarily to find a stock that I'm going to buy simply based. I'm not going to say, okay, this stock does well in February, so on January 31st, I'm going to buy it at the close. No, I don't think that's a good idea. But if a stock looks good technically and you know that the seasonal pattern also is bullish, then I think that's worth taking a look at. Now, I've talked about Priceline in the past many times, so I'm not going to bring that one up again. I do want to mention, though, another stock or another group, which is heavy construction. The DJUSHV. Oops, I wanted to do that with the seasonality, sorry. And after this one, we'll wrap it up. But the DJUSHV, heavy construction, if we drag it back over the last 2 decades roughly, you can see how February and March really pick up. 63% of the time going up in February, 72% of the time in March. And you can see that the average gains, again, very strong, 2.6% average monthly gain in February, 3.3% in March. Add those two together, you got about a 6% average return in heavy construction over the last 19 years during these 2 months, February and March. So this is an interesting area. And then if I go and take a look at an individual stock, which for this one, I'm going to use Jacobs Engineering, JEC. And let's drag it back over the last 20 years. February is just kind of so-so, 50% of the time up, but it does average gaining 1.3%. But look at March. March is a huge month for JEC as part of this heavy construction index. 74% of the time, JEC rises during March, and it averages going up 4.5% during the month of March. So this is one that, knowing the seasonality, I'd want to look at the chart. And if we take a look, this stock was getting hit hard along with the market recently, but it did hold on to this prior low, put a tail in below it, held it, and has rallied back very strongly. And I think this one remains in a pretty nice uptrend, JEC. And if you look at the weekly chart, you can see, again, this pullback, pretty scary on an intra-week basis, but we have now held that rising 20-week moving average, and we've been doing that the last several months after breaking the downtrend. So JEC should benefit from some seasonal tailwinds as we go forward. So why don't we just do a quick recap on the seasonality report. Talked a little bit about the toy index, talked about the heavy construction index, mentioned the travel and tourism index where Priceline belongs. I just didn't want to get into that because we've spent so much time in the past. You can certainly pull that chart up on Priceline. It's amazing, PCLN, and look at the seasonality. But the first several months of the year, clearly Priceline looks ahead to some strong summer travel. And as a result, the stock does really well in the first half of the year. So much better than the second half of the year. It's really odd over 19 years that there'd be such a disparity. So with that, let's go ahead, I guess, and get ready to wrap up, Erin. I don't know what you're thinking about the market here. I mean, still, as you mentioned, the VIX is still up there. We still have the capability for some pretty big swings in both directions. And I know you and I were talking about before the show. I think the bottom went in yesterday, and you're not quite so sure, but I'll let you.
Oh, well, that was for the sake of that exercise. I'm just going to say.
Okay. Fair enough.
I just wanted to give everybody a peek here of my climactic indicators. So you can really see how the volatility index, the VIX, had been really, doing very little. When you see a spike like this and it turns everything else into just a straight line, you can't see the Bollinger Bands. You can barely see them. But I wanted to point out the fact, yesterday we got a spike as far as the positive breadth is concerned, and we're now starting to pop back up into the Bollinger Band for the VIX. So at this point, I would be looking for, I think this was an initiation, getting this spike, and obviously we're still seeing some upside potential. My thing is, we had those W's, back, I think I have it here real quick. We had these double bottoms, these W's that came in after really deep declines. And honestly, I'm looking for that. I think we're going to have a great bounce off of this because it was such a deep correction. But I think we're going to be in for another test of the lows, could even go just a bit below that. Whether we're really in for like the whole bear market drag, I'm not so sure. I'll be watching these intermediate term indicators really closely to see if that's going to be the case. I think they'll be pretty good for us.
Yeah, I could be looking really silly in a couple of days after saying I think the bottom is in, but I do think that things are a lot different now than they were in 2015. I think that back in 2015, there were a lot of different mixed signals in terms of performance, various sectors and so forth. I think this has been an incredibly strong bull market where money has continued to rotate into riskier assets. And that's why I think it's a little bit different than the others. The other thing, and again, I'll go back to my earlier discussion at the beginning of the show, is a lot of these other VIX spikes that we've seen over the last couple of decades, they've tended to occur in the summertime when the market has a seasonal propensity to decline. And I think now, being in February through April, where the market does tend to do pretty well, I think we're getting the correction we need. But I'm actually looking for some sort of continuation pattern to develop here. I don't think we'll consolidate near these lows for very long. That's just my guess and my opinion. But we'll see. I mean, time will tell for sure.
Absolutely. Well, what's coming up this week? Tomorrow, we have Arthur Hill coming on the program for a segment. And Tom's going to be doing a tips and tricks workshop on Friday, give you an idea of how he sets up his chart lists and just some of the things you use, right, that help you through your day.
Yep. It'll be interesting. I'm going to go through and just, I'm still putting it together as we speak, but it'll be a fun one. And I did look at the survey responses yesterday. A lot of you wrote in and asked, about some different topics. And this was kind of the one that was hit on the most, was just how I use the website and some of the things that I do. So we'll take a look at some of that on Friday. I think it'll be a really interesting session for sure. I want to thank everybody for stopping by today and being with us. It was great having Gordon Scott on. Certainly look forward to having him back. Please remember to complete the survey as you exit. We'd love to get your feedback and hear what you think of Market Watchers Live. As a reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. We'll see you back here on Thursday. Happy trading.